You're listening to certified financial planner Doug Goldstein, host of the Goldstein on Gelt Show, www.goldsteinongelt.com.
Okay, I'm very excited to have on the Goldstein on Gelt Show Gary Antonacci, who introduced into the investment world a concept called dual momentum, which combines relative strength, price momentum, with trend following absolute momentum. Now, hold on. We're going to ask Gary exactly what that means before you flick away. So, Gary, what do all those words mean to normal people?
Relative momentum or relative strength is an idea that's been around a long time. That's where you compare the performance of an asset to its peers, and you would select whichever one has performed better. And an abundance of research has shown that performance is persistent, so that better performing assets tend to continue to perform better than their peers. Absolute, or sometimes called time series momentum, is a trend following approach where you're actually looking at the performance of an asset with respect to itself over time. For example, if the S&P 500 has been up over the past year, then you would say it has positive absolute momentum and it should continue to go up, so you want to continue to hold on to it. If, on the other hand, it's been going down over the past year, then it's said to have negative absolute momentum and you want to stand aside. And what we usually do is go into a safe harbor like short to intermediate term bonds when that occurs.
Okay, so let me say it back to you, make sure I understood it. So the first concept is momentum, or dual momentum, where you're comparing how one thing does against other similar assets. So if you were to look at you wouldn't compare the S&P 500, let's say, to the return on your bank deposit, but you would compare it to some other large cap index, a whole list of other major American companies.
Typically, what you compare to is the rest of the world, because momentum works best on a geographic basis. So what we do, and what I describe in my book, is comparing the S&P 500 to the all-country world index, which is basically the rest of the world.
And you feel that's a good comparison, even though because they are different. One of them is in America only, and also the structure of these indexes is different, so you're not comparing apples to oranges?
Well, they both have mutual funds or exchange-traded funds available for them. They're both broad-based, highly liquid, and they capture a lot of what's going on. So it's really a global macro kind of approach, because when the U.S. dollar is strong, U.S. stocks tend to be strong, and they tend to outperform and continue to outperform. Whereas when the U.S. market weakens, sometimes non-U.S. stocks continue to be strong, and that's when you want to be in them.
Let's talk about something that you just said, which is that a strong dollar is indicative of a strong stock market. A lot of people feel that it should be the other way, that if the dollar strengthens, it's going to be very hard for U.S. companies to export. Why does that make sense that it would actually be a connection between a stronger dollar and a stronger stock market?
It has to do mostly with fund flows. The U.S. dollar is regarded as a safe harbor. It's where everyone wants to be, particularly when the dollar is strong. And the best place to be in terms of liquidity and return historically has been U.S. stocks when that occurs.
Okay, let's focus a little bit more for a minute on this concept of using a comparison of, let's say, one investment against a similar investment, and trying to understand how that jives with what people on Wall Street, in fact, like me, often say, which is past performance is no guarantee of future returns. You seem to focus a lot on past performance. Do these two concepts go together, or is this something that you actually disagree with?
Well, in general, that's good advice. Past performance should not be regarded as indicative, because it depends how you look at past performance. The way a lot of people look at it, that's true. And that has to do with the nature of the markets. On a 3 to 5 year basis, the markets are mean reverting. And academic research has shown this. Also, in periods of 1 year or less, the market is mean reverting. So in fact, if something has been strong over 1 year or less, or over 3 to 5 years, it would tend to be weak going forward. But momentum is an intermediate term phenomena that works on a 3 to 12 month basis, and an abundance of academic research has shown that momentum holds up, not just across U.S. stocks, but across pretty much all assets. all asset classes, all different markets, all different time periods, going all the way back to the 1800s until now.
We're speaking with Gary Antonacci, who is the author of the award-winning book, Duel Momentum Investing. He's been talking to us about this concept of dual momentum investing, as well as relative strength price momentum. I want to touch on something you mentioned before, which is this concept of mean reverting. First of all, let's start by, can you explain what that means? And then we'll dive in a little bit further.
Mean reversion is a tendency when things get overextended to go back to a longer term average. So studies have shown that stocks that have been especially strong, or markets that have been especially strong over the past 3 to 5 years, tend to be weaker than average going forward, and vice versa. Things that have been battered down over the preceding 3 to 5 years tend to rebound on a relative basis. That forms the foundation for what some people call value investing, where you're taking advantage of assets that are depressed and expecting them to come back over time.
So is this more theoretical, do you think, or actually practical? In other words, when everyone retrospectively is usually, well, not everyone, but most people retrospectively can invest really well. They say, yeah, had I only sold, in 2007 and then waited till 2009 and bought back in. And then we say, yeah, but it's hard to do that because you don't know. At what point can you tell if it's about time for the index or whatever market you're looking at to begin to revert to the average?
Well, that's where you have to look at the academic research side of things, because if people just arbitrarily say, well, it's gone in one direction for a while, it ought to go back the other way, they could get themselves into a lot of trouble. So that's why we use a very rules-based, quantitative, systematic approach, where we identify mean reversion as existing in a period of 1 year or less, or 3 to 5 years, and momentum as existing in a period of 3 to 12 months. And this has been clearly established in hundreds of academic papers now.
Yeah, I like the way you're describing it. It reminds me of a conversation I had a few years ago. I had on the show here world chess champion Susan Polgar, and we were talking about how the strategies of chess can be applied to investing. In fact, she and I ultimately wrote a book about it called Rich as a King. And one of the things I like about the way you're describing what you do is that you've got a specific strategy, the way you look at the markets. So my question then to you is, tactically, what do you do? In other words, you've got the big picture, but how do you, or is this something that an individual can actually move on to make some money?
Oh, definitely someone can move on it. That's why I wrote a book on the subject called Dual Momentum Investing. So typically what you would do is you would look to see whether the S&P 500 has been going up or down over the past year. If it's gone up, then you apply relative momentum to ask whether the S&P 500 has been stronger than the rest of the world or not. And if not, then you invest in the rest of the world. If the S&P has been stronger, then you invest in it. On the other hand, if the S&P 500 has been going down over the past year, then you want to stand aside and go into something like short or intermediate term bonds. And you reevaluate that on a monthly basis. It's very easy to do. You can use a chart-based internet program to do that. That's freely available. It takes 2 or 3 minutes a month to do this. And the advantages over buy and hold are considerable.
All right. I know that the way you described it in 1 minute is not the complete story, so I just want to let people know nothing is super simple, but it is something that you can learn by reading Gary's book. And of course, always remember that that there is risk to all sorts of investing, so just be careful with that. But I definitely think that these ideas and the fact that that what you've studied, Gary, is something that you didn't just check it out over a year or two, but looked at it over the long term, makes it important for people to really realize that there are strategies that they can apply, but they have to be consistent at applying them. One of the things that we are consistent at here on the Goldstein on Geld show is our time. So I'm getting a signal from my producer where you're just about out. But Gary, in the last few seconds, just tell me, how can people follow you and follow your work?
They can go to my website, optimalmomentum.com. I also have a blog, which is dualmomentum.net. And the best way to really understand what I do is to get my book, Dual Momentum Investing.
Okay, we will put a link to all of that at the show notes of today's show at goldsteinongeld.com. Gary, thanks so much for taking the time.
My pleasure. Thanks for having me, Doug.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.